Hi, everybody. Welcome to today's stream. So, I have a really current stream today. So, we're going to go through 5 things buy-to-let investors must know in 2026. So, legislation, the mortgage market, new strategies and products coming to the market, which you've got to be aware of. So there's a couple of things I really want to get clear today, and a couple of big things that you'll see in the media, see on the headlines. So I thought it was worth diving in a bit deeper and giving you a bit of a understanding to what's actually happening in 2026 and make it really, really clear some things you need to be doing if you're considering investing in property. So what's changed, what's coming, and where the opportunities are going to be some of the key points that we'll consider. So for those who don't know, my name is Nick. I'm the managing director of Verta Property Group. We've got a network of 31,000 investors globally. I've been doing this for or in various property roles on and off for developers, management companies, investment firms for 10 to 12 years. We've got hundreds of 5-star reviews and obviously involved in hundreds of millions of pounds of transactions of property. So got really good pulse of the market in terms of the investor mindset, and combining that with some research and some statistics, hopefully I can give some really good insights to this topic today. So, right, let's kick things off then. So, firstly, point number one is mortgages in general. So, when the Iran war kicked off, so to speak, there was a big withdrawal of mortgage products from the marketplace. So, if you look at BBC back in, I think it was the 11th of March, they quoted that over 400 products were withdrawn from the market. And we had many investors that were going through, the agreement in principle stage. They were formalizing mortgages, and that completely changed almost overnight. So the mortgage and the lending market at the moment is really volatile. The instability in the, geopolitical climate is causing ups and downs, products to be pulled, fluctuations, etc., etc. So what you need to consider around that is, one, if you get a good mortgage offer, take it, try and move fast and secure it. Number two, if you were borderline on getting a decent mortgage product in terms of terms that you're happy with, i.e., interest rates, deposit levels, etc., make sure, if you've researched this previously, that you circle back around to it before you perhaps are ready to complete on a property, or before you actually need to formalize the mortgage in real time. So, for example, we'll have off-plan investors that, 3 months ago, they might have had a discussion with a mortgage broker and said, right, you're fine, you can go ahead, you're more likely to get lending on these terms. Here's an agreement in principle. They go ahead, reserve a property. Now, if they go around, say the project is completing in 3 months' time, if they go to get a mortgage now, it's likely that they'll be offered different terms, different products, different lenders. So you just got to circle back if you're in that situation and make sure you're dealing with today's market. Now, one thing I wanted to add on this is, with off-plan investing, it can be a good angle to look at the moment, because it gives you the opportunity to secure a property with, a 10, 20, 25% deposit, benefit from that capital value rise during the construction period, i.e. appreciation. And then you are able to formalize your mortgage on completion, which is likely to be a more attractive marketplace. So it can be a good idea if you want to kick the whole mortgage process down the road. You don't want to deal with today's interest rates, today's lack of products, the constant withdrawal and additions of specific products to the marketplace. If you buy something off plan, you can still get that capital growth during the construction period, but you don't have to worry about the mortgage side of things. So keep that in mind. That could be something to consider. But yeah, mortgage products and you being aware of the conditions in the marketplace is definitely something you need to consider, probably for the coming months, or the foreseeable, with real concern. So, point number two, and there was a huge amount of press around this. Oh, my camera's come off. Sorry, guys. Hopefully that's okay. Let me. Okay, should be good to go. I don't know why the camera I'm using always seems to cut out for some reason. Let me just lower that slightly. Hopefully good to go there. So Renters' Right Act is coming into play from the 1st of May. So in a couple of weeks at the time of recording. Now, this is a big change for the UK market. So a couple of points to keep in mind. Number one, Section 21 is abolished. Now, what that was, for those that don't know, is landlords could give tenants notice to be evicted, minimum of 2 months notice, I think it was, and there didn't have to be a reason. It was just there at their discretion whether they wanted to get a tenant out. Now that's changed, and they must use specific legal grounds to evict a tenant. Okay, and that's from the 1st of May 2026. So it just means a bit less flexibility, a bit more advanced planning in portfolio planning in terms of if you're looking to dispose of things or change letting style, for example, moving from long let to short let, and you want to get the long let tenant out. You just got to keep that in mind. So Section 21 is abolished. Periodic tenancies. Now, this for me is a very big one, because you used to be able to get a tenant in your property, sign a 12-month agreement, and you know you've got them effectively locked in for 12 months. Okay. Now that's completely changing. The tenant is now not going to be locked in for 12 months. So they're moving from what was called assured short hold tenancy agreements, which is a traditional 12-month term, to periodic tenancy agreements, which effectively is a rolling monthly contract. So the tenants just have to give 2 months notice, and then they can leave. So number one, it provides a bit more instability and a bit less certainty for landlords, because if they leave, then you've got to pay lettings fees, find another tenant, and go through all the motions again. And then in 3 months, that tenant could leave. So you really got to make sure your property is up to scratch. If you're getting furniture, make sure it's done properly. Maintenance is looked after. You're there for your tenant. And that way you'll make sure, and obviously working with a good managing agent, that way you'll minimize your risk. But it's definitely a big change in the marketplace. And stronger tenant protection. So rent increases once a year, minimum 2 months notice. Tenants can challenge rises. I believe there was changes around deposit collections as well. I believe you can't collect substantial amounts like 6 months up front, or enforce 6 months rent payment in advance for highly in-demand properties and things like that. So do some reading on it. As I say, it's known as the Renters' Right Act, or Renters Reform Bill, you might have heard it as. So keep that in mind. Make sure you're on the right side of the law, you're remaining compliant, and you're following the relevant procedures. But yeah, that's definitely something you have to know about in 2026. So far we've covered the mortgage market and how that's choppy and changing in 2026, and the Renters' Rights Act, which is new regulations and legislation coming into effect on the 1st of May 2026. So they're huge things to be aware of. Now, point number 3, this is kind of a given. It's not really specific to 2026, but it's becoming, with those other points combined, it becomes more and more important. And that is considering purchasing in a company name, or otherwise what's known as a SPV. So there are tax benefits to doing this. Most people know there are various benefits, that they don't know exactly what they are. And I'll just reel off a couple now, just to give you a bit of an understanding. Obviously, this is not tax advice. We've got accountants who we use if you want to speak to anyone. But firstly, full mortgage interest relief. So when you're instead of being able to deduct your mortgage payments from your profitability, and as a result pay less tax, you're given a credit. I think it's 20%. And instead of that, what's happening now, sorry, that still exists. But if you're buying in a limited company name, you can still deduct that payment. So in other words, it shows that the company is making less profit. As a result of that, you'll pay less tax. So that's a really significant one, the mortgage interest relief. Obviously, you've got the general tax level changes. So, well, not changes, but differences versus corporation tax and personal income tax. So most property investors, they tend to fall in to the higher income tax brackets, 40, 45%. So if you go purchase a property in your own name, and then that income comes and it's counted within that stack of income, then you ultimately have to declare it, and you're going to be taxed at that rate. But if you're buying in a company name and you set it up then you're going to have corporation tax exposure, which is likely to be, I think it's 25% now, 25%. I think it's depends on the level of income earned. I'm not exactly sure on what the specific rate is. I know I pay 25%, but it's better than 45%. So obviously the general tax structure is more advantageous. And also when you're buying a company name, there can be other benefits. Again, this is changing constantly, so do double check. But you can retain profits in the company, so you can reinvest and put more properties into that without withdrawing income and being taxed on it. In the future, there are benefits when you're selling the property in terms of stamp duty for the next buyer. And you've got to think about things like capital gains tax as well. So there are various advantages. But as I say, the main thing is when it's a softer market, there's less mortgages available. Developers are bringing less products to market. There's more regulation and more costs potentially around managing tenants and the property themselves. And if you've really got to be on the ball, then you might have more maintenance costs. As a result of that, the impact is your bottom line is going to be, going to shrink a touch. So you really got to make sure your tax structure is optimized. Cool. Point 4, location. So the point I wanted to make on this is a lot of investors, or what you might see in the press, is they often judge the UK market as a whole in terms of the performance of the property market, but it's really unwise to do so because certain pockets of the UK perform much better compared to others in terms of capital appreciation, in terms of rental yields, in terms of product, in terms of tenant demand, in terms of the developer profile, etc. So there's large there's large differences compared to buying in central 1 or 2 zones in London versus in Middlesbrough or whatever. So keep that in mind, do your research and make sure you're going into a market which is going to perform well or is expected to perform well. So a lot of people say, oh, I'm not near the property, or I want the property near me so I can manage it, or I can look after it, I can keep an eye on it. I'm based here, so I'm going to buy here. It's really unwise, especially nowadays where you can have and just operate a complete remote structure. So one way I wanted to demonstrate this is 2 high-performing residential investment markets in the UK, Liverpool and Birmingham. Okay, so people would regard these, a lot of our investors, they look outside of London. So London investors are kind of a different category, so to speak, because it's just fundamentally it's a different market. It's like its own country. But outside of that, all the satellite cities, Manchester, Liverpool, Leeds, Huddersfield, Sheffield, Newcastle, Birmingham, Wolverhampton, and then down to the south coast, etc. Mostly the Midlands and the north is where the real demand is. But even buying in 2 of those cities, for example, can yield profoundly different results. So if you look at the Home Track Capital Growth Index, which is a monthly report, it's called the House Price Index, which gives you a rolling capital appreciation rate of the top 20 cities across the UK. In other words, it will show you each month what markets are performing well, what's that year-on-year capital appreciation rate, and it's released monthly, so it gives you really good, up-to-date, almost current insight. Now, at the moment, Liverpool is the number 1, and very commonly is the number 1 performing market in terms of capital appreciation. So they have it down as a 4.3% growth rate year-on-year in their latest available data, whereas Birmingham, again, another city that's mentioned alongside Liverpool, is 1.7%. So Liverpool is growing on average 4.3% per annum. Birmingham, 1.7%. Okay. Now, obviously, that's only a couple of points, and it might not seem like a lot in the first instance, but the way to look at this is if you look at an example purchase of £250,000 at the Liverpool rate, let's assume that continues for 5 years at 4.3%. Then the gain on that is just shy of £60,000, so £58,429, and the value would be £308,429 after 5 years. So in other words, you buy in Liverpool, looking at conservative market data, projecting what the rate is now over the next 5 years, you're looking at just about 60 grand in equity that's built and profit made if you're going into the Liverpool market. Now, if you do the same for Birmingham, it's 21,982. So just shy of 22 grand. So you're talking about a £36,000 difference just from going into Liverpool versus Birmingham on the capital growth alone. So the exact difference is £36,447. So nearly let's just say 36 grand difference in your pocket. And again, a lot of our competitors, including us, we sell Birmingham and Liverpool. Investors will weigh them up and they'll think, I like Birmingham, not too far from London. I've heard some good things about it. I've heard the HS2 line is going in there. Let's have a look at that. So they're very flippant and casual about their decisions, but you've really got to nail down and look at the market statistics. And that just gives you one demonstration. And I haven't, even touched on rental yield yet. So you're probably, if you get a good property in Liverpool and you do it on the short let market, you can look at an 8%, 9% net return after management fees. Birmingham, you might be looking at, 5%, 6%, or let's just assume you did a long let. There's stuff that we've got in Birmingham which will generate 4 to 5%. So you're talking nearly double on the rental income as well. And let's just say that's, if you get 10% in Liverpool and 5% in Birmingham, that's 25 grand a year on the short let market in the Liverpool one. And that would be 12.5 grand a year on the Birmingham one if you're doing a 5 versus 10% yield. And again, you forecast that out over 5 years, add that to the equity play as well. You're talking a significant amount of difference, probably touching 6 figures on. I mean, my maths isn't perfect, but it's going to be up there, 80 to 100,000 pounds difference in your pocket from buying in Liverpool versus Birmingham. Okay, so yeah, I've stressed that. The key point is, I'm not saying you have to buy in Liverpool, but what I am saying is make sure that you're doing your relevant due diligence and not speaking to your mate, not looking at BBC News. Look at the specific stats which are taking place in these marketplaces. So yes, we use Home Track, and that's one source backed by Zoopla, but we also look at obviously land registry data, Office for National Statistics, look at the future forecasts from Savills, JLL, Knight Frank, etc. And once you combine a variety of sources, you can build up a picture and get a really strong understanding. But most don't do that. So keep that in mind. Cool. So moving on from that point now. So yeah, just to reiterate then, another, as I say, in 2026, location is very important because your margins are being stretched. You've got to make sure if you're putting 50 grand in, put it into a good performing market. Okay, point 5. This is more anecdotal, and this is kind of based on myself being in the marketplace, speaking to developers every day, speaking to investors every day, often partnering with competition, mortgage brokers, solicitors, accountants. I've got a good pulse on the market in terms of what's actually happening out there. And what I'm seeing in 2026, from COVID onwards, really, from 2020 up to 2024, the UK was flying. We were some of the biggest sellers for, key developers up in the Northwest, particularly in 2023. But the past 18 months, 2 years, it's slowed down significantly in the UK. The demand has softened a lot, and developers have been stretched on costs of building, regulation. There still hasn't been really any amazing planning changes, so they've still got a lot of hoops to jump through. As a result of that, less products are coming to the market. So the ones that are on the market, they do, they might see a higher premium if there's less competition in that specific local area. But what I'm really seeing out there at the moment is investors are in the marketplace. So there's a number of ways we measure that. So one, as I say, we've got a network of over 30,000 investors. So as you can imagine, our job is to market to those investors, add value, introduce products, understand where they're at, what they're considering, what their mindset is, what's the sentiment in the marketplace at the moment. And basically, our job is to find investors that are active and are willing to transact. Now, we are generating a lot of interest from our database when we have the right product. Okay, so we can send emails out, WhatsApp sends, and if the product is good, we will generate people that will put their hand up and say, yes, send me the full information on this. On the surface, this looks good. I'll have a deeper look. So there's a big segment of investors that are sitting there on cash waiting for the right product, in my opinion. And that's not just UK based. That's, a lot of the Middle Eastern and Far Eastern guys that make up our database as well, and African. So, demand is there. The other way we measure it is via new traffic. So when we're advertising on the likes of Google, Instagram, Facebook, this is how we're reaching consumers, so to speak, or property investors. And we measure that via the cost per lead. Like, how much does it acquire me to get an investor's details and then market to them and ultimately transact with that investor? So they're kind of the metrics where you can get a sense of how hot the market is and how much demand is in the marketplace just from our own internal information and operational circumstances. Whereas that doesn't count speaking to other agents, speaking to mortgage brokers on the ground, how busy are management companies, what are the yields or what the rent is being achieved in certain places at the moment, etc., etc. So that also gives us a good understanding. So by accumulating all that data, in my opinion, what's happening at the moment is, one, investors are not jumping at any opportunity. We used to launch a product in 22, 23, any city center, and you'd have people, as long as this price was reasonably good, you'd have people plowing money into the market. It was very active. Now that just doesn't happen. You can't launch a product 2 years out with an average rental yield, an average deposit structure, an average specification in an average location, and expect investor demand. You just won't get it, and it won't sell. Well, eventually it will sell, but it will be a slow burner. So if a product, however, is priced well in a good location and the investment fundamentals are there, then you will have the investor demand. Simple as that. So that's what I'm seeing at the moment. Price sensitivity is obviously very, very strong. People are not afraid to ask for discounts, push developers, because they know the overall macro sentiment isn't as hot as it was a couple of years ago. And the other thing I'm seeing as well is a lot of investors moving towards fixed return deals. So you might have seen all these investments, social housing, HMOs, rental assurances from developers offering 8, 9, 10, 11, sometimes 12% fixed return. And you've got these investors that have just been sitting on cash for 2 years. And if you're saying, look, I'll give you 10% for 10 years, give me 150 grand, then a lot of people do that. It's the fastest selling type of asset in the marketplace, without doubt. Ready property with a guaranteed return is the fastest selling. So we are getting a lot of attention on that. Whereas before we might have had people that are putting 70 grand into an off-plan investment and just roll the market because the appreciation was so aggressive. They didn't really have to do much, put in their deposit level, wait a couple of years, bang, that's a 80% return on cash invested over a 2-year period. That doesn't really happen as much unless the product is perfect. So yeah, long story short, without waffling too much, from what I see in the marketplace, investor demand is there, but it's only there for the right product, which has to be structured correctly and brought to market with good marketing, with good incentives, and with good fundamental structure and investment merits. If you've got that, then the product will likely sell at an appropriate pace. If not, then it's just going to sit on the market. And there are developments out there that's happening with right now. And then the other thing is, a lot of investors are moving towards fixed income investments, where they want that certainty, they want that predictable income month in, month out. They don't want to deal with service charge rises, with management fees, with now the Renters Reform Act, providing less certainty than perhaps it did before. We've had investors say specifically, get me a guaranteed return because of the tenancy agreement changes that are coming into the marketplace. So yeah, we're seeing it firsthand. But I'll wrap that up there, guys. Just to recap on the 5 points that you must be aware of if investing in 2026. Point one, mortgage products are changing frequently. Interest rates, fixed fees from the mortgage brokers, from the lenders, and products are coming in and out of the marketplace, mostly being withdrawn until the certainty or the volatility dies in the geopolitical climate. Number two, the Renters' Rights Act coming in May 2026. So Section 21 are removed, so you have to give tenants legal grounds to evict them. The shorter tenancy agreements are coming into play, and more legislation in general. Buying in a company name is more important than ever. You get to write off your interest, mortgage payments. You get to benefit from corp tax over personal income tax, and there's better planning, better exit strategies as well for portfolio holders. For location, buying in the Northwest versus buying in the East Mids is going to yield profoundly different results over the coming years. The tens of thousands of pounds difference, and they're lower priced up Northwest as well. So yeah, keep that in mind. Location is important than ever. Do your research, do your relevant due diligence, and make sure you're buying somewhere that suits your goals. And point five, the market reality right now is that a lot of investors will move if they get the right product. So that's why you don't have people jumping in and products selling out in months or a couple of months like they used to. But if you've got the right product, then we understand that investors are in the marketplace for that sort of thing, and investors are considering fixed return products, guaranteed rental assurances and this sort of thing. So yeah, I'll wrap that there, guys. Wrap that up there. Any questions, let me know. Contact details are in the description, and I'll see you on the next one.